Hedging Class 3, Financial Terms and Instruments. In Class 2, we briefly discussed a few terms used on the Mercantile exchange. This class will delve deeper into these concepts. Commodity. A commodity is a term for the name of the physical product being sold. These include, but are not limited to, agricultural products, energy, metals, currency, and various other commodities. Contract. A contract, sometimes referred to as a paper contract, are financial instruments traded on the Mercantile exchange and represents the commodity purchased or sold. Contracts are sold for specific months, and the last day of trading is determined by the exchange years ahead of time, based on where the weekends fall on the last week of the month. If you do not close this position, you must accept delivery of the product, or, if you sold the contract, you must provide the physical product at the basis point. Purchasing a contract is referred to as going long, and selling a contract is referred to as going short. Every commodity has a specific quantity that it is traded in. Crude oil trades in barrels, heating oil trades in gallons, and cotton trades in bushels. Option. An option is the right to purchase or sell a contract before the option's expiration date. The expiration date of an option is generally 5 days before the contract's expiration date. There are two types of options: puts and calls. Call. A call is the right to purchase a contract at a strike price. All calls have strike prices and expiration dates. Strike price. The strike price is the price the option is exercised at. The strike price can be on the money, out of the money, or in the money. The premium for a call is comprised of two different factors. 1. Where the strike price is in relationship to the current trading price. 2. The volatility of the market and a few other lesser factors such as interest and carrying costs. An in-the-money call means that the market is trading above the strike price of the call. An on-the-money call means that the strike price of the call is trading around the current market price. And an out-of-the-money call means that the market is trading below the strike price. An example of an out-of-the-money call would be if the prompt month is trading at $1 and the strike price of $1.20. If you had bought the call with a strike price of 85 cents, the call you bought would be 15 cents in the money. The intrinsic value of a call is the premium you pay above how far in the money the call is. Generally, there are three factors comprising the intrinsic value. Volatility, the period of time remaining to the expiration date, and interest. In our first example, our strike price was 20 cents out of the money, and let's say that there were only 5 days left to the expiration date. If you were to purchase this call for 3 cents, there would be a 3-cent intrinsic cost for that call, since the call was 20 cents out of the money. In our second example, the call was 15 cents in the money. If we were to purchase this call for 21 cents, we would be paying a 6-cent premium over the difference of the call's strike price, less where the market is trading at. This means that the call had an intrinsic value of 6 cents. In the heating oil market, options can be exercised before the expiration date. Like contracts, every call must have a buyer and seller. When the buyer and seller arrive at an agreed-upon strike price and premium, the trade would be consummated. The purchaser's loss is limited to the premium paid, and his gain would be limitless. For the seller of the call, the maximum profit would be the premium paid to him, while his loss would be unlimited. In our first example, the call was 20 cents out of the money, with 5 days left before the option's expiration date. If the purchaser or seller did not close out this option, and the option's strike price remained out of the money, nothing would happen when the option's trading date expired. The purchaser would have lost the premium that they paid for the call, and the seller would keep the money he received for the call. Please note that options are not matched, and the seller may have closed his position 5 minutes after selling the option, while the buyer may have taken the option to the expiration date. In our second example, if the market had remained 15 cents above the call's strike price, and the purchaser did not close out his position at the expiration date, the buyer would receive a long contract that was 15 cents in the money for the prompt month. He would not receive the physical product, as the call was a right to buy and not a contract to buy. If the seller had also not covered his position, he would receive a contract that was 15 cents out of the money for the prompt month. Put. A put is basically the opposite of a call. It is the right to sell a contract at the strike price. Its value is based on where the strike price is in relationship to the market, the volatility of the market, and the time left to its expiration date. The purchaser of the put can only lose the premium they paid to purchase the put. The profit can be unlimited. The seller of the put maximum profit is the premium they received for the put, while the loss can be unlimited. Open interest. Open interest is the number of contracts or options that need to be covered before the month expires. When a contract is sold, there are 2 open interests generated, one for the buyer and one for the seller. Each open interest is closed separately. Convergence. Convergence is a term for one of the bylaws of the Mercantile Exchange. It mandates that there must be a smooth conversion of the selling price of paper instruments to the physical products at the last minute of trading for the expiring paper instrument. Basis. Basis is the location where the physical product is delivered. Cotton's basis is Chicago, heating oil's basis is New York Harbor, and propane's basis is Mount Belvieu, Texas. Contango. Contango is a term used for the smooth movement of all the months of the commodity being traded. If a commodity demand is the same every month, the commodity's price should be slightly higher every month going into the future, as each month would have interest and carrying costs. When a commodity has a seasonal demand, such as heating oil, the highest prices should be in the months of peak demand. If we consider a heating season to be September to August, we would anticipate that prices would rise from September to January and fall from February through August. This pricing pattern for heating would be referred to as the commodities contango. Spot market. The spot market or cash market is the current month where commodities are purchased and sold immediately. The Mercantile Exchange does not trade in the spot market. Backwardation. Backwardation is the term used when there is a shortage of physical products in the spot market, causing the prompt month and near-term months to have higher prices while future months have declining prices. There is a tendency for a vicious circle to develop, as suppliers do not want to carry the physical product in storage, as they would lose money if the market remains unchanged. As a result, most suppliers resort to just-in-time inventory, which exacerbates the problem, as any bump in demand results in shortages. Hedger. A hedger is a trader that has a physical product that needs cost protection. Generally speaking, their profit is made by selling physical products to customers. In the Northeast, it is commonplace for local retail oil companies to offer cap and fixed price protection to their customers. By providing these plans, they must have hedging that enables them to lower their costs if the market should fall. Additionally, they control how they change their retail prices to their retail customers. Speculator. A speculator is a trader that is trading without a physical product to hedge. Their profit is made by trading with other traders. Although they may have an overall view of the market direction, they are more concerned with the changes in price or differentials. Trading houses have complex trading models that generate automatic purchases and sales depending on the market movement. A speculator has no problem purchasing a contract at all-time highs if the market is trending higher, whereas a hedger would be very hesitant to buy a contract at an all-time high. A common term used by a speculator is the trend is your friend, whereas a hedger is always concerned with keeping their cost at the lowest price possible. Liquidity. Liquidity is the measure of trading volume for a commodity. If there is a high volume of trades, the commodity is considered very liquid, as there usually will be a seller for every buyer. Markets such as propane have very limited volume, consequently they don't have the ability to trade options. Resistance. Resistance is a term used when large amounts of sell orders are placed at one price. The computer models used by speculators determine where these price points are based on historical data for that month's contract. Support. Support is a term used when large amounts of buy orders are placed at one price. The computer models used by speculators determine where these price points are based on historical data for that month's contract. Range-bound. Range-bound is a term used when a product doesn't have enough momentum to break through resistance or support. Margin. Margin is the amount of money required by the exchange to maintain a position. Generally, your broker would require you to deposit into an interest-bearing account. The exchange requires that every account be settled every day. A heating oil contract is 1,000 barrels, which equates to 42,000 gallons. Consequently, every time the market moves by 1 penny, the change in the value of your account would be $420. Henceforth, if you purchased a contract that lost 10 cents a gallon, you would lose $4,200. If your account balance is below $4,000, you would be required to deposit into your account. Most brokers require a wire to be made that day or the next day, unless they will liquidate your entire account.